Hello everyone, John AG here, and I need you to cease scrolling because silver just obtained hit in a way that should make every stacker, every trader, and every I'll purchase it later procrastinator pay attention. A few hours ago, silver appeared like it was attempting to maintain itself together. Then out of nowhere, it obtained slammed so difficult that the movement didn't experience like a dip. It experienced like the market pulled the emergency brake at full speed. And here's the aspect that's going to mess with your head. This didn't materialize with one clean, evident headline. No neat press release. No single breaking news banner you can point at and state, yep, that's the reason. Which means the genuine narrative is in the plumbing. Liquidity, leverage, stops, and the levels everyone was leaning on. In a minute, I'm going to demonstrate you the one level that determines whether this is a brutal shakeout or the first crack of a bigger reset. One quick thing, short and direct. I'm pushing back against copycat channels in this space, and I need your assistance. Subscribe and leave a comment, even if it's merely our John AG, so the algorithm understands you're backing original labor. All right, now let's obtain into what occurred, because this movement was not normal volatility. This was a crowded trade obtaining punished, and the speed of the drop is the giveaway. Markets can drift lower when demand is weak, but when price drops like a trap door opened underneath it, that typically means stops, forced liquidating, and thin order books are executing the damage. Here's the sequence that matters. Silver spent days compressing, higher lows pushing up, but upside progress obtaining weaker. That structure can appear bullish to casual observers because price is still rising. But to anyone observing momentum, it's a warning. The spring is obtaining tight, and the release is going to be violent. In the hours before the smash, silver attempted a recovery. It pushed up, teased the crowd, and provided that familiar sensation. Okay, perhaps the correction is executed. That's how the market lures in late purchasers. Then it hit a ceiling, stalled, and rolled over. And once the key pattern fractured, the market executed what it always executes when leverage is stacked on one side. It punished the most emotional currency first. Now, I understand some people hate chart discussion, so let me maintain this practical. Patterns don't predict the future like magic. Patterns inform you where the crowd is positioned, where the crowd experiences safe, and where the crowd possesses their stop orders sitting. And the market loves nothing more than walking price into the location where the most people are incorrect simultaneously. If you've been around silver for a while, you already understand this is the asset that loves to embarrass people. It's hated, it's volatile, and it's thin compared to many major markets. One sharp push can trigger a chain reaction. That's why you have to separate your emotions from your plan, because silver doesn't care how confident you experienced yesterday. Now let's address the question. Everyone maintains questioning. What caused it? Sometimes the cause isn't a narrative. Sometimes the cause is positioning. If the market is loaded with leveraged longs, if stops are clustered below support, and if liquidity is thin, especially outside peak hours, price can collapse far merely to discover genuine purchasers. That's why after-hours movements can appear unreal. In thinner sessions, there are fewer bids. If purchasers step back even briefly, price doesn't glide down, it drops through layers. And when that drop hits a pocket of stops, liquidating isn't optional anymore. It becomes automatic. So the first question you should be questioning isn't, which rumor executed this? It's, where were the pressure points? And the pressure points were evident. A tightening structure, a trend line everyone was leaning on, and a support zone that had become a psychological crutch. And here's where the narrative games commence. The instance silver obtains hit, you'll perceive the loudest voices claim, this proves silver is a bubble, or proves silver is finished, or proves you should exit before you lose it all. They'll state it with certainty because certainty liquidates. But certainty is frequently a signal that someone desires you, frightened, distracted, and late. Because the truth is, silver possesses these events. It always has. And the people who succeed in silver are the people who can reason clearly when the candles transform violent. Now, let's zoom into the structure without transforming this into a tedious textbook. Trend lines aren't lasers. They're zones. They represent areas where purchasers have defended price before and areas where liquidators have been rejected before. And when a zone fractures, it doesn't merely transform the chart, it transforms the psychology of everyone observing. This is the critical flip. Old support becomes new resistance. People who purchased at support and didn't liquidate when it fractured frequently panic and liquidate on the retest. That liquidating pressure makes the retest fail. And when the retest fails, the breakdown becomes confirmed in the minds of traders, which invites more liquidating, more stops, and more momentum to the downside. That's precisely why the retest matters more than the first fracture. The fracture is chaos. The retest is information. So here's your first cliffhanger. If silver revisits the lows and bounces immediately, that signals genuine demand. If it revisits the lows and hesitates, drifts, and slips, that signals weakness. And if it revisits the lows and slices through without a combat, That's when you initiate preparing for a deeper correction and a longer grind. Now let me inform you what I executed. The instant I perceived the smash, I didn't run to social media to panic. I pulled up two things, the chart structure and the physical market. Because if you're serious about silver, you should never examine only one side of the equation. On the physical side, I immediately checked what was actually cheap and what was still overpriced in premium terms. Here's the funny thing about physical. Different products conduct themselves like different submarkets. Sometimes bars are the bargain, sometimes coins are the bargain, sometimes older circulated silver is the bargain. And sometimes the product everyone utilized to disregard becomes the value execute during a shakeout. In this environment, the surprising bargain has frequently been older circulated silver, lower premium relative to spot, easy to recognize, and sometimes priced in a way that makes you double check, because you've been trained by past years to expect higher numbers. Meanwhile, certain shiny new products can remain stubbornly expensive even during a crash, because premiums lag and supply chains shift slower than charts. That's why you don't merely question, did spot drop? You question, did the all-in price drop in the products I actually purchase? Now, on the paper side, a substantial amount of people attempt to hedge with options or short-term trades when volatility spikes. And examine, if you understand what you're executing, hedging can be a tool. But in silver, paper positions are executing on a field where overnight gaps and thin sessions can execute damage you didn't plan for. If you're trading a popular silver ETF or a futures contract, you can be correct on the substantial picture and still obtain wiped out by the timing. That's why I maintain repeating survival first. If your plan can't survive a violent candle, your plan isn't a plan, it's a wish. Now, when I'm examining the chart, I appreciate to flip between different time views because it transforms what you perceive. On a very short view, you perceive the chaos, the waterfall candle, the bounce, the spikes. On a 4-hour view, you initiate perceiving the genuine structure, where the rally commenced, where the support was constructed, and where the market determined to flip the table. On a daily view, the shock becomes perspective. The identical price that experiences low today may still be historically elevated compared to where the market sat merely weeks earlier. That doesn't mean the market can't go lower. It means you need to maintain your perspective so fear doesn't hijack your determinations. Now here's the key overhead zone that matters. The trend line or channel that supported silver's run for months has now been challenged. On one chart view, it appears like price barely touched it. On another view, it appears like a clean rejection. That's why intelligent traders treat trend lines like zones. The exact line isn't the point. The battle area is the point. If silver can reclaim that battle area and close above it decisively, that's one of the cleanest signals that the correction is cooling. If it can't, then every rally attempt risks transforming into a liquidate the bounce opportunity for trapped purchasers. And yes, I'm going to position a number on it in a general sense without pretending it's a perfect laser. Consider it as an overhead zone in the high double digits to around the psychological triple digit area. The exact level shifts with time, but the concept is identical. Reclaim, maintain, and then construct higher lows above it. Now let's discuss Fibonacci retracements in the simplest way possible. Many traders pull a retracement from the base of the rally to the peak. There's a classic golden support zone where purchasers frequently manifest. During this smash, price tagged that general area and bounced difficult. Does that guarantee the bottom is in? No, but it does inform you something. Genuine purchasers were awaiting there, and the bounce was aggressive enough to matter. This is where the market splits people into two groups. Group 1 perceives the crash and states, it's over. Group 2 perceives the crash and states, a discount merely manifested. The distinction isn't intelligence. The distinction is time horizon and preparation. Now let's add another piece that most people overlook, global pricing conduct. Sometimes you'll perceive regional markets maintain a premium even when the headline price drops elsewhere. That premium can tighten during panics, but the fact it exists informs you there's still genuine demand for metal, not merely speculative paper flow. So the next time you perceive a crash and someone declares silver dead, question them a basic question. If it's dead, why do physical premiums exist whatsoever? Why do purchasers still manifest? Why doesn't the physical market instantly flood with liquidators? Now let's discuss miners for a second, because a substantial amount of people confuse silver spot price with the entire ecosystem. Mining shares frequently conduct themselves like leveraged silver. That means they can drop more difficult in a smash, and they can rip more difficult in a rebound. If you're examining opportunities, a smash can generate bargains in miners, but it can also generate traps. You desire to examine quality, balance sheets, and how the stock conducts itself relative to the metal. Some miners obtain punished even when they shouldn't. Some miners deserve the punishment. And in a panic, the market doesn't care. It liquidates first and questions later. So if silver remains volatile, don't be surprised if miners appear like a roller coaster. Now let me rewind the tape and describe what this appeared like in present time, because the timeline is part of the lesson. First, you possessed that composed stretch, price attempting to recover, candles appearing organized, and the crowd initiating to believe the liquidating was executed. Then you obtained the first crack, a pushdown through the lower boundary of the tightening range. That isolated doesn't always mean disaster. Markets fracture down and reclaim constantly. But what transformed this into a genuine event was the failed reclaim. Price snapped back up, tested the fractured area, and then obtained slapped back down. That's the instance the market states, no, you're not obtaining back in. And once that occurs, psychology flips instantly. Confirmation purchasers cease purchasing, late buyers initiate dumping, and short liquidators who were excessively frightened to enter at the top suddenly experience brave because they possess a clean invalidation point above. That's why I maintain calling the retest the diagnosis. The fracture is dramatic, but the retest is where the market discloses intent. And yes, I'm going to annoy the purists for a second. I don't care if your trend line touches every single wick. If you need your line to be a perfect laser, you're overlooking the point. These are zones where participation concentrates. If price rejects in the zone, the communication is identical. The market isn't a geometry class, it's a battlefield. This also explains why different chart types can make the identical narrative appear different. Sometimes the log view makes the movement experience calmer because it scales percentage transformations. Sometimes the regular view makes the rejection appear cleaner. You don't select the chart to be correct. You utilize both to comprehend how different participants are perceiving the combat. When I flipped to a broader view, one thing stood out. This run up into the highs wasn't merely random pumping. It was constructed on repeated dip purchasing and a trend that trained people to assume every pullback would be rescued. That conditioning is powerful. It generates confidence. And then the market fractures that confidence to remind everyone that confidence without a plan is merely vulnerability. Now maintain perspective. After a nasty correction, silver can still be sitting at levels that would have been celebrated as historic not that long ago. Volatility executes mind games. It makes you forget where you came from. It makes you treat still elevated as ruined, simply because you perceived a higher number last week. That's why the word decimated fits the vibe of this movement. In its old meaning, decimation was a punishment utilized to restore discipline. Markets execute something similar. They purge leverage, punish late chasers, and restore discipline. And they execute it in the most humiliating way possible, so people swear off the trade right before it transforms. Now, some of you are reasoning, well, what if that substantial run genuinely was the top? What if that was the blow-off? Fair question. There are always analysts who can draw a Fibonacci extension or point to a round number ceiling and state, see, it hit the level. That was it. Sometimes those zones do matter. But a technical level isn't a fundamental explanation. It's a behavioral marker. For a genuine long-term top, you normally need a shift in circumstances. So question is, did we suddenly obtain a world where debt is contracting, budgets are disciplined, and currency dilution ceases? Did we suddenly obtain a surge of new mine supply that overwhelms demand? Did we suddenly obtain industry shifting away from silver in a meaningful way? If those answers are no, then one violent candle doesn't automatically equal the termination of the narrative. That stated, the flush can continue. And this is where long-term trend tools matter. A substantial amount of market participants observe the 200-day moving average as a rough health meter. When price is above it and the average is rising, the trend is generally intact. When price collapses toward it, it can act like a magnet. And when price fractures below it and the average rolls over, that's when a trend transition becomes more plausible. So yes, a deeper reset is possible. And if it occurs, it will examination conviction. This is why I maintain dry powder. Not because I desire crashes, but because I understand silver possesses tantrums. If you possess no dry powder, every dip experiences like a disaster. If you possess dry powder, dips become opportunities, and you can select your timing instead of being compelled by emotion. Now let's discuss why movements like this can occur on no news. In modern markets, the trigger can be as simple as a substantial order hitting a thin book, an algorithm scanning a level, or a fund decreasing exposure after a volatility threshold is breached. Once the first domino collapses, the rest becomes mechanical. Stops trigger, risk models adjust, dealers hedge, and you obtain an avalanche that appears like it was caused by something when it was genuinely caused by structure. That's why you should be skeptical when you perceive a headline composed after the fact claiming a single cause. The cause might be plumbing, not narrative. One more phrase people throw around is paper silver could go to zero. Don't accept that literally as a prediction that the number on the screen becomes zero tomorrow. What it typically means is that paper claims can become irrelevant in a world where physical delivery and genuine scarcity dominate. In that world, the question shifts from what does the quote state to can you obtain the metal and what is the genuine world exchange value? We're not completely in that world yet. But Nights like this remind people that paper pricing can conduct itself in ways that experience disconnected from physical reality. And that realization is precisely what pushes some people to prioritize tangible holdings. Finally, yes, maintain an eye on the opening bell effect. Overnight sessions can exaggerate movements. Then regular hours open, liquidity returns, and you can perceive either continuation or reversal. Sometimes the open brings a second wave of liquidating because people react late. Sometimes it brings a violent bounce because the liquidation exhausted itself in thin circumstances, and genuine purchasers step in when the market is completely staffed. So don't assume the overnight print is the whole narrative. Watch how price conducts itself when the market is awake. And that's why I'm observing the identical two things again and again. 1. The defense of the low zone. 2. The reclaim of the fractured overhead zone. Maintain the shelf, reclaim the ceiling, and the narrative can transform rapidly. Fail to reclaim, and the market may demand more time, more pain, and more discipline from everyone involved. One small detail I'm also observing is how physical premiums conduct themselves after a shock. Sometimes spot drops, but physical doesn't follow immediately because inventories are tight and liquidators don't rush to undercut each other. Other times, the premium compresses because dealers obtain flooded with orders and adjust rapidly. If premiums remain stubborn while paper whips around, that's a quiet signal that genuine demand is still there. If premiums collapse everywhere, that can signal genuine strain and liquidation. Either way, it's information worth tracking in present time for anyone stacking through chaos. Now I desire to bring this back to the larger picture, because this is where people obtain tricked. When you stare at a one-night crash, your brain attempts to rewrite the whole narrative. It informs you. See, it was all fake. That's emotion discussing. So what would actually have to transform for the long-term thesis to fracture? You'd need debt and deficits to improve meaningfully, monetary expansion to reverse in a durable way, supply constraints to disappear and demand to collapse, confidence to return to fiat, and for genuine assets to suddenly become unwanted. Do you perceive that occurring, or do you perceive the opposite? Because as long as the broader monetary backdrop remains messy, as long as governments maintain running the machine hot, and as long as silver's industrial role remains significant, the larger thesis doesn't evaporate merely because the chart obtained violent on a Wednesday night. Now, I'm not here to pretend nothing can go incorrect. Silver can correct further. It can retest deeper moving averages. It can generate a long sideways range that examinations patience. It can make people quit right before it shifts again. That's what it executes. So here's your second cliffhanger. The most painful examinations frequently occur right before the market makes the movement that convinces everyone it's excessively late. That's why you don't need to predict the exact bottom. You need a plan you can execute. Here's a simple approach that maintains people from self-sabotage. If you're stacking physical, you can scale in. That means you purchase some when fear spikes. You maintain some dry powder, and you're willing to purchase again if price dips further. You don't bet the entire plan on one candle. You construct a position like a professional, not like a gambler. If you're trading, you await confirmation. That means you examination higher lows, reclaim levels, and calmer volatility before you risk substantial. You accept that you might overlook the exact bottom because your task isn't to catch knives. It's to catch trends after the market proves itself. Now let's address the bubble argument directly, because it's going to be spammed everywhere after a crash. A genuine bubble isn't merely a rapid price elevation. A bubble is a price that becomes detached from the broader backdrop. Currency expansion, scarcity, and genuine world demand. One simple lens is to compare silver to the expansion of currency supply. The measuring stick matters. If the measuring stick is being stretched through ongoing monetary expansion, then nominal highs can be misleading. That's why comparing today's price to some old price without context is a trap. In past peaks, silver's ratio to broad currency measures was frequently far more extreme. Today, the run was hot, and it needed a reset. But the idea that a single correction proves the entire multi-decade structure is finished is the type of lazy conclusion that obtains people wrecked. Now let's discuss the long base concept in plain language. When an asset spends years struggling under major highs, it constructs energy. When it finally fractures out, it can run, but it seldom runs in a direct line. It surges, it corrects, it constructs, and it surges again. The correction isn't the termination of the narrative, it's part of the narrative. And that's why it's hazardous to label one difficult drop as the final top, unless you can point to a genuine fundamental shift that justifies it. Now, to maintain this script A style, I desire to bring in a viewer-style question that I've been obtaining repeatedly. People maintain questioning me. John, should I be frightened of paper price games? Should I disregard spot and merely stack physical? Here's my answer. Paper price is the scoreboard the world observes. You can't disregard it, but you also can't treat it like it's the only truth. The physical market is slower, but it's genuine. If you're maintaining physical, your concentration is ounces in long-term value. If you're maintaining paper, your concentration must include risk management, because the paper world can gap, freeze, and whip around in ways that shock you. So the finest approach depends on your objective. Protection and long-term purchasing power? Physical makes sense. Short-term trades? Respect the risk, or the market will instruct you. Now, let me drop something in creatively precisely the way I guaranteed. If you desire silver-related achievement narratives, genuine people, genuine journeys, and how they constructed prosperity through discipline, there's another channel linked in the description. Subscribe to it too and perceive how people remained consistent and actually made it occur. Now let's discuss psychology, because this is where most people lose. The market's task isn't to make you currency. The market's task is to transfer currency from impatient people to patient people. When price runs up, it generates greed. When it crashes, it generates fear. Both emotions make people make poor determinations. Your only defense is a plan, and your plan has to be constructed for volatility, not constructed for comfort. That's why I always state survival first. If your position size is so substantial that one overnight movement ruins your sleep, you're excessively substantial. Scale it to where you can reason clearly, because the market utilizes fear as a tool. Now, I desire to question you 2 questions for the comments, and I desire genuine answers. 1. Do you reason this was a pure liquidity and stops event, or do you reason someone deliberately pushed the market to trigger a cascade? 2. When silver obtains slammed like this, do you prefer purchasing physical, purchasing miners, or executing nothing and awaiting? Drop your answers below. And while you're down there, if you're successful, if you've constructed something, if you've hit a milestone, share a quick victory in the comments. It boosts morale for everyone observing, especially newer people who are obtaining their first taste of silver's mood swings. Now, I also need to inform you something significant. By the time you're observing this, a members-only video will already be published. It bundles the key updates in one location and goes deeper than I can go in a public video. If you desire the in-depth breakdown and premium analysis, join the membership and observe it. It also demonstrates me, who's genuinely following closely. And again, if you desire faster alerts than YouTube can deliver, join the WhatsApp channel in the description. That's where I can drop instant notes when price executes something crazy at odd hours without awaiting a complete upload. All right, let's bring this back to what the crash actually means. For traders, it means risk is genuine and leverage must be respected. For stackers, it means the market merely presented a discount, but you must be intelligent about how you accept it. For everyone, it means the next movement matters more than the last candle. The crash was the punch. The bounce and the retest are the diagnosis. So here's your 3rd cliffhanger. If silver can reclaim the fractured structure and transform it back into support, the people who panic sold will have to pursue their entries back. And that pursuit can be violent. But if silver fails at resistance and rolls over again, we could perceive a deeper reset that shakes the sector longer than most people expect. That's why you don't marry one outcome. You observe the levels, you observe the closes, you remain flexible. Now, one error most people make right after a crash like this is overreacting to the first bounce. They perceive a bounce and assume the danger is gone, or they perceive a bounce and assume it's fake. Either way, they commit excessively early. The smarter movement is to permit the market to demonstrate U structure. Higher lows, reclaimed levels, calmer volatility. And yes, that means you might overlook the exact bottom. But you'll also avoid obtaining chopped to pieces in the whipsaw zone where the market attempts to confuse everyone. Now, one more thing. When the market experiences an aggressive flush, it frequently resets sentiment so difficult that the next rally doesn't initiate when people experience confident. It initiates when people experience exhausted. It initiates when nobody trusts the bounce. And that distrust becomes fuel. So observe the sentiment. Observe the silver is dead posts. Observe the confidence collapse. Because when the crowd obtains loud, the market is frequently close to flipping the script. So here's how we terminate this. If you desire my execute by execute reasoning, subscribe. Quick and effective. Subscribe now because the next movement is going to trap the most people. If you desire daily micro updates and voice notes, join the WhatsApp channel in the description. If you desire the complete premium breakdown, join the membership and observe the members-only video that's already live. And finally, leave a comment, even if it's merely our John AG. It supports the campaign against copycats. It assists the algorithm. And it informs me you're part of the core community. Remain sharp, accept care of each other. And remember, silver doesn't shift to reward comfort. It shifts to reward preparation. And the next chapter initiates sooner than most people,